Good afternoon, everybody. My name is Joe Warther, and I'm senior lecturer here at Georgia Southwestern State University. I want to just talk to you a little bit today about Chapter 22, Budgetary Control and Responsibility Accounting. When I look this chapter over, there's really three big concepts that you have to know. You got to know how to put a flexible budget together. There'll certainly be 4 or 5 questions on flexible budgeting. You have to know responsibility accounting, and the kind of questions you'll see there is you'll have to give me an example of a profit center, an investment center, and a cost center. And then you have to know the last part of the chapter, return on investment, okay, which is controllable margin over average total assets. Okay, they call this return on investment, ROI. Now, how do you get controllable margin? Well, all that is contribution margin minus controllable fixed costs. Okay, so that you have to know controllable margin. And of course, controllable margin is what's used in figuring out return on investment. Now, the beginning of the chapter talks about the difference between a static budget and a flexible budget. And let me just say that a static budget is a budget that is similar to the one you learned in Chapter 21. The master budget, the operations and the financial budgets, that's called a static budget. What a flexible budget is we wait till the end of the accounting period and we look at all the actual production that's taken place. And we adjust the static budget with the actual results, and thus we get ourselves what we call a flexible budget. Now, once we get this flexible budget, we compare the flexible budget with the actual results, total actual results. And what we're talking about here is sales minus contribution margin, which is direct materials, direct labor, and variable manufacturing overhead. We're talking about the deviations between what the flexible budget was and what the actual results of those numbers are. And that deviation is called a variance. For example, if our actual sales would be greater than our flexible budget sales, we would have a favorable variance. If our actual expenses are less than our flexible budget expenses, we have a favorable variance. So what we're trying to do is we're trying to adjust the budget to reflect actual performance. And then we're looking at our actual numbers and comparing our actual numbers to this new flexible budget. So just keep in mind, a static budget is a budget that is made before the accounting period starts. And a flexible budget is one that is made at the end of the accounting period. And what we're doing is we're adjusting the static budget with actual performance results, okay, actual activity. The unit prices that we set up at the beginning of the year for sales and direct materials and direct labor and manufacturing overhead, those unit prices all remain the same, okay. We call those standard prices, okay. They're what I always called budget unit prices. They don't change. All we're doing is we're looking at our actual activity and we're multiplying those unit prices times actual activity and getting a new budget, which we call flexible budget. So that's kind of in a nutshell what flexible budgeting is. You need to read over, starting on page 1137, how a flexible budget works, and it's explained very well, how to develop the flexible budget, and you can even look at the illustrations that they have. A really good illustration is illustration 22-13 on page 1141, and then there's one on page 1143, illustration 22-16, which is a very good illustration. It shows you variances, which we call differences or variances, and F is favorable and U, of course, is unfavorable. Okay, so that'll kind of give you a good idea. If you look at those illustrations, it'll kind of teach you how flexible budgeting works. Just remember that all we're doing is we're taking the static budget, which was developed before the year started or the month started, and we're adjusting the static budget to reflect actual activity that actually took place during the month. And we're coming up with a new budget called a flexible budget. So that's important. Like I said, 4 or 5 questions on flexible budgeting. Responsibility accounting is also important. You have to kind of know, what responsibility accounting is about. And again, terms like management by exception, decentralization, segment reporting or segments, I will expect you to know those terms in the chapter. Those are all terms that are concerned with responsibility accounting. And of course, the last part of the chapter talks about return on investment, analyzing an investment decision. That's what return on investment actually does. And I'll expect you to know terms like controllable margin and, of course, the return on investment ratio, which is controllable margin over average total assets. You'll get probably 3 questions on that. Probably I would expect from this chapter most likely at least 15 to 18 questions from this chapter on the exam. So that's pretty much the chapter in a nutshell. You want to make sure you do the self-test questions on page 1166. And I do have some flexible budget problems, multiple choice questions out there in GoView for you to practice. So there's quite a bit, as far as, you learning the material. I like the brief exercises at the end of the chapter, and I like some of the exercises, and I really like the multiple choice questions. The big key in doing well on these exams is you gotta do the multiple choice questions over and over, because that's what the exam is going to consist of. Okay, hopefully we're going to do better on this exam than we did on the first and second exam. I have made an adjustment to the second exam. I believe I added 7 points, and there's going to be a 15-point quiz this weekend actually coming up, which will be the weekend of the 14th, 15th, and 16th of July. And you can take those 15 points if you get all of those questions right, which is very possible. A lot of students do get them right. You can add those 15 points to your second exam score. Remember, the grade is figured out on points, and you need, the course is 400 points, but there's actually an extra 40 points built into the homework that you can get that will help you bring your exam scores up also. So the big key is doing all the homework and trying to get the homework right so you get the 140 points. You only need 100, but there's an extra 40. And then you can take that 40 points and you can also add that to your exam scores. So really, when you think about it, with the 40 points built into the homework, plus the 15-point quiz, plus the 7 points that I adjusted exam number 2, that's what, 62 points, 62 extra points that you have a chance to get to help you out, if you didn't do well on these exams. So stay with it. I will be in Americus, Georgia next Monday and Tuesday, and just looking at the date, that will be the 17th and 18th of July. I will be on campus in my office. If anyone wants to come in and talk with me, discuss their grade or go over material for the exam number 3, which will be coming up later that week, you're welcome to come in and see me. I'll be there all day Monday and all day Tuesday. Please don't hesitate to get a hold of me. My number is 216-403-3775 if you have any questions. Thank you very much.